Okay, here we go. Quiz, last quiz of the semester. We're going to go through the questions. First, I'm going to take a drink. I'm not telling you what it is, but it's pretty good. Okay, so this question is about an exchange of an asset for another asset in which there was boot, cash. We learned about that. We're told that it lacks commercial substance. As I described in class, we wouldn't have to be responsible for determining when an item is, or an exchange is for commercial substance or lacking commercial substance. The problems would tell us. And in this particular case, there are going to be two correct answers. One would be B, because in class we said that at one point we said all lack of commercial substance deals that we don't recognize gain or loss. That's one approach to GAAP. The other approach is that if it's a loss, we do recognize that, but no gain. So either the $40,000 loss is what you would have computed if you'd done the numbers, and if you're having problems seeing that, just let me know. But you can see if you go through the actual numbers, the company exchanged lost money on the deal. Okay, so that's number one. Number two, we have Wilson Company purchasing land. So here the question is, what goes into the cost of the building? It's a late night, so I'm taking a couple more drinks. I may not be able to get to the end of this video with the number of drinks I'm taking, but we'll play that by ear. And of course, with the final tomorrow at 8 o'clock in the morning, I'll probably wake up with a headache. This is for the Friday final, so if you're in the second class, that's still on for Monday. So here what we need to do is we need to determine how much goes into the cost of the building. So they bought land, $900,000. That's clearly not part of the building cost. They paid $80,000 to tear down buildings on the land. That's just to get the land flat and get it there so you can do something with the land, but you don't know what you're going to be doing with the land yet for that 80. It's not clear. That just tearing down the buildings doesn't say you're going to build a building. You could be doing a farm. You could be bringing cows onto the land, so who knows. Then we had legal fees, which they tell you was for the purchase of the land. That's here, so that's clearly not part of the building. Title investigation was for the purchase itself, so that's not part of the building. Architect's fees, that comes over here. Architect's fees, we're going to start doing green those expenses that'll be part of the building cost. So that's in there. Title insurance at the time of the closing of the land, no. Again, that's related to the land, the title insurance. However, the liability insurance during construction, that's a key. Construction of what? The building. That's part of the building cost. And then we have two, $31,200. Then we have excavation costs. That's for the building, because you have to excavate the land in order to have the building there. That's not just for the land. That is specific for the building. So that's why that goes in there. And then, of course, you pay the contractor. That goes as part of the cost of the building. And the pavement cost here, where it says real estate taxes, although I'm circling in green, I'm going to now, oops, that's an interesting color. I'm going to mention that real estate taxes is not considered part of the cost of the building. So that it's just a cost. It's an expense of holding the land. And you might have been able to figure that out by the fact that it was real estate taxes assessed for pavement, which is related to the land. I'm not sure the logic works there, but that's what the rule is. Interest costs, we did learn that during construction, interest costs are all part of the cost of the building. So if you add all that up, you'll get D, which is the right answer. That's how that worked out. Okay, page 2. Page 2, Miser exchanged 4,000 shares. What are we asking for? Here is how much is the cost of the land. So the issue is here, they didn't pay cash, they used shares at $25 par value, but that doesn't matter. What's the fair value of the land? The fair value of the shares of stock. That's what they gave up. So what did they give up? The value of the share was $50 per share. I probably need a calculator here someplace. $50 per share. And then they got back $12,000 for selling scrap that was part of what they bought. It was part of the land that they bought. It was on an existing building on the property that they removed. So the true cost of the land is the fair value of the stock that they gave up minus the $12,000 that they got back for selling scrap. So let's see what that is. $50 per share, 4,000 shares is 200,000 minus the $12,000 for selling the scrap. 188 was the correct answer, C. Okay, depreciable, number 4, depreciable assets. This is a sort of a trick question because it wants to know is that at the end of the useful life, the accumulated depreciation would equal the original cost of the asset under which of the following depreciation methods, and it will never, the accumulated depreciation would never equal the original cost if there's salvage value. The accumulated depreciation will be net of salvage value because we won't depreciate the salvage value, so the answer is no and no. Business determines to use double declining method, so we want to know the base, the depreciable base, and the multiplier. And here we learned that the key is that the depreciable base with double declining is always the full amount, even though we're not going to depreciate it beyond the salvage value, but it's always the full amount. And the factor is the number of years times 2. So if you had 4 years, that percentage would be 25%. 4 years equals 25%, but we double it for double declining, so it would make it 0.50 or 50%, and that's why C is the correct answer. All right, we're on a roll. I don't know where we're going, but we're on a roll. All right, number 6, we have here what we want to know is how much is goodwill, and simply have to do here is take the total of what they're paying or what for, and that is they are. First of all, we know what they're going to pay for. They're going to pay $1,950,000, but what is it that they're buying? So we're buying $9 million of assets value minus the liabilities plus the, and this is this $9 million is not the fair value. This is the book value, I should say. So we have to increase the book value by the fair value, and of course the problem tells you that there's $600,000 that needs to be added, fair value added. Let's just make sure you can see that. See the fair value there? So that gets added to the book value, and so does, I think that's it. That was the only thing. So let's see if that works out. You take $9 million minus the liabilities that they're assuming, $3,750,000. That's $5.25 million. Add the 600. You get 5,850. But they paid 9,150. The difference is 3.3 million. Under the residual method, if you're not sure what you're doing here or what I did, just look up the residual method of goodwill calculation. That's what we just performed. So we took the actual known values minus the liabilities, the known values, the known fair market values, and we came up with the difference is goodwill. All right. When a company develops a trademark, what costs are, which of the following costs associated with a trademark would not be capitalized? This is sort of an easy question because we learned in class that research and development costs are never capitalized unless you buy it from somebody else. They're always expensed. What amount to be realized gross profit? So what is this? This is an installment method of accounting. So this problem required you to use the installment method, which meant figure out the gross profit percentage here, the GP percent for these sales in 2014, and then for the installment sales made in 2015, figure out that GP percentage and apply those percentages to the amounts collected in 2015. That's the year we're concerned about. So what was collected in 2015? Well, it tells you that on these sales here, they collected $200,000. So you apply the gross profit percentage to that and get a number. And then for the 2015 sales, which is this gross profit percentage, apply that to here, and you get the number for the gross profit recognized on those sales, that 240. You add them together, of course, and you're going to wind up with B152. All right, let's see. Cooper Construction Company. This is a problem regarding percentage of completion contracts. So what we need to do is figure out what's our estimated cost of completion and what's our gross profit, because that's what we want to know is the gross profit for the year 2015, and that's when the contract started. Well, you can figure out the gross profit based on the price that they're selling the deal for, 18 million minus the estimated cost, that's 1.5 million. How far have they gone in the contract? Well, the amount of cost to date was 7.5 million, actually 7,590,000 over the estimated costs here, tells us that we are approximately 46% into the deal, and multiplying that times the 1.5 million will give us the 690,000. Answer B. That's it. That's how you do percentage completion. And before I get sober again, let me take another drink. That's good. All right, number 10 is completed contract method. What amount do we recognize for gross profit? And the year they're asking for is 2015, which is when the job was finished, 2015. And so under completed contract, you simply add up all your costs as they actually happened in both years, or however many years it took. You add up all your costs, and then you compare it to the fee that you're charging. Oops, that could be written better. You compare it to the fee. Basically, take the fee and subtract the cost, the actual cost, and you're going to come up with your gross profit made, which in this case will be 2.5 million. Answer D. That leaves us to the last question, which was the written question. And let's see, where is that problem? Here it is, down here. Which asked you to describe what is the account called progress billings. I'm going to show you how easy this was to answer. Of course, it always looks easy when you're on this side of the video. But this was simply, the answer was simply, all you had to do was put contra account, or you could have written contra asset account. That would have been fine too. But it's a contra account. What do you call the netting of this? And that means that, by the way, we learned it in class a couple times, but when you see the word contra account, it means it's going to net, it's going to be allowed to be netted against some other account. So we're going to net it, and the problem tells you we're going to net it against the cost to date. The problem actually even told you that, so you didn't have to even remember that part. And what do you call it when you net the two, and where does it go on the balance sheet? So the answer there would have been, you call that, let's see, what do you call that? What do you call the netting? What did I mean by that? That's a good question. What did I mean by what do you call the netting of these two? And where does the bound? What do you call the netting of these two? On where does it go? Oh, it meant, and where does it go on the balance sheet? So you, I don't know what you call the netting of it actually, but you could have simply said that you call it. You do this. You call it the cost compared to billings, or progress billings if you wanted to. That's what you could have said, because that's what you're doing when you do this on the balance sheet. And I guess if you read the second part, or the C part of the, you said, what do you do when progress billings exceeds cost to date? You could have simply just said, then you will show it as a liability. And this, by the way, you could have just said, is traditionally an asset when the costs exceed the billings. And that's what you would call it on the balance sheet, costs in excess of billings. And here for C, you would show it as a liability. That would be your answer there. And it would be just the opposite name, billings in excess of costs. Another way to have answered the question of B is you would have called it, you could have said that, what do you call the netting is too? You could have described it as netting. Let's do it this way. You could have just described it as netting the inventory of costs against the billings. That's what you could have said. All right, so that basically wraps it up. If you have any specific questions and you're taking the Friday exam, I won't have any chance to answer that. I don't know how we would do that. So But you can try sending an email, and I'll do my best before midnight tonight to take a look at it. And that is that.